Welcome to the Smart Money, Dumb Money show, and I'm your host, as usual, Keith Richards. I'm President and Chief Portfolio Manager with Value Trend Wealth Management, and we have another exciting interview today. I'm really quite pleased with this one because, as you guys know, all I ever do on this show and through my blogs is talk about technical analysis, and that can get stale after a while. So every once in a while, I like to have a guest on who covers an aspect of financial analysis or financial planning that I don't do. And today's guest is most certainly one of those people. You guys have probably heard of her. Her name is Ellen Roseman. And if you've ever read the Globe and Mail or the Toronto Star business section, you'll know who she is because she's a long, I was going to say an old dog in the business, but that's not nice to say. So we'll say
A
she's
seasoned
a
reporter. That's what they say. A seasoned
so
observer.
she's a seasoned observer in the financial business. So her insights as a reporter and a person who's been involved with the industry for a long time. So quick bio, and I've already given you part of it, is that Ellen was with the Globe and Mail from 75 to 96 as a consumer issues columnist, but she moved over to the report on business. And covered personal finance and mutual funds, and did an awful lot of the analysis pages back then. You guys might remember when mutual funds were actually popular in the 90s and stuff. That Ellen was actually responsible for setting up a lot of the Globe and Mail analytical pages. So she's got some real insights there. And she also currently, so I'm reading, you can see I'm looking down because I always have to look at someone's bio before I talk. So she ended up with the Toronto Star, which is kind of funny because the Globe and Mail is a renowned paper for the business section, and the Star not so much. But she
that was the challenge, and also it was a good way to be able to negotiate a higher salary.
There you go. There you go. Here's a blank slate. Go for it. So that's what Ellen did, and then finally, she's lately been an instructor at the University of Toronto in finance, as well as she runs an investment club, and we'll talk about that. She brings in people like me. I actually spoke to their club a while back, and so individual investors can benefit from that. So I want to start off right off the bat, because Ellen, your background was in mutual fund analysis. Again, most of my readers are not mutual fund investors, but some of the insights that you gained, we were discussing before the show. Maybe you can kind of bring us up to speed on what were your experiences while doing that.
I don't know if I'd even call it analysis. It was more like putting a spotlight on mutual funds. I interviewed a heck of a lot of managers, and I enjoyed it because they were ahead of everyone else in finding companies, visiting companies, giving us their thoughts on whether or not this was a trend. And all these interviews were interesting. But often the most articulate fund managers weren't actually putting up very good results. And I was the editor of a monthly section. Both the Star and the Globe had it. And all it was lists and lists of all the mutual funds with all their different A class and B class and C class, and their performance over 1 year, 5 years, 10 years, 6 months, for people who they thought really wanted this information. And a lot of them did, and they held on to it. But it's the funniest thing, because when I started covering mutual funds at the Globe and Mail, they still had an evening edition that came out around 6 or 6:30, and it was only sold in newsstands on the streets in Toronto. And the people who owned mutual funds would rush out, buy the paper, check the prices, and say, phew. And remember, mutual funds were always, especially the industry would always say, this is a long-term purchase. It's not for the short term. You shouldn't be checking your results often. Once a month is probably okay. So if they kept these monthly things, they were fine. But many of them wanted to see it every single day. And I'm hoping they weren't making decisions as a result of a one-day, change. But they were, for many of them, this was their first experience of the stock market. They were always told that the stock market is too difficult for you as an individual. You need a lot of money to get started. You probably have to have 100 shares of every stock that you buy. None of that is true anymore. But they felt that at least now that they were in the stock market, and if they were getting good performance, they could talk about it a lot. And one of the things that I did with the monthly was that I discovered, and many people had told me this as well, that if the fund had one great year, and 4 bad years, the 5-year returns would be averaged out and make it all look better. But that's not really helpful for the investor because they want to see what's the worst loss you might take if you own this. So we would put like the worst, I think over 5 years, and then the best increase you would get. So instead of that more comforting, 5 years averaged out, it's 8% a year. You could see that some years, calendar year returns. That's what I bought in, a calendar year return. So you could see what it did in 98, 99, 2000, 2001, 2002 separately. And that gave you a much better idea of the volatility of the mutual fund. And people liked it a lot, though it did take up more room. I thought it was a useful indicator. But the big thing was that back when I started my career as a journalist, and I didn't even go to journalism school, I worked on the McGill Daily, which was just a volunteer activity, but it awakened my interest in reporting. It was the late 60s, the Vietnam War was on, there was a lot of student activism. And then I started writing about consumer issues, which also involved activism. And way back in the early 70s, when I was starting to write, inflation came back with a vengeance. And Prime Minister Trudeau, his father, started a food prices inflation board with a woman called Beryl Plumtree, who came out of the Consumers Association of Canada, a very well-educated group of mostly middle-class women who were interested in trying to make the market better. And she did a whole bunch of reports on the inflation in the food industry and how to avoid it and how to bring it down. And that got me all excited about consumer activism. And I followed that a lot in the Globe for my first 10 years. And then I switched over to business, and I thought I'd be writing purely business. But then I discovered that the mutual fund industry itself was something that really needed a shakeup. It was not consumer oriented at all. The big company, I started there in October 87, which was when the market took a dip. And it wasn't even fundamentals. They blamed it on the computers, and the computers weren't working properly. And it came back very quickly. But the big company in mutual funds, aside from the banks, which weren't that big then, was Mackenzie Financial. And they had a fund that they had just started at that time. So it looked golden because it hardly had any investments, so it didn't go down very much. It mostly had cash. But they were very arrogant. They didn't like talking to the media. They didn't like talking to their customers. And the way the business worked was that the fund company would have a lot of meetings for the dealers who were independents, usually working for firms like Asante and Regal Capital Planning, and they would have a big spread of food and drink in an evening. They'd give a speech or two, they'd show some presentations, they talk about their results. And I heard about these things, and I thought I'd try to get to one. So I had a friend who could bring me there. And what I also noticed was, as well as talking about investments, they would talk about all their great vacations that they had in the Caribbean and in Europe, getting together to talk about mutual funds. So these companies were actually sending them around the world to do educational seminars. And that seemed wrong, right? And finally, somebody got me into a session just with the people behind Mackenzie. And I went up to one of them afterward, and I told him I was an investor reporter. And he said, well, we don't talk to the media. I said, why not? He said, because you write for the investors, but our clients are the fund sellers, the dealers. Those are our clients. Those are the only people we need to talk to. So there you could see a company that really couldn't see beyond, getting a great deal with these dealers, and it cost them a lot of money to do that. So the guy who was running it, his name was Geller. He was in charge of the Ontario Securities Commission. And once he learned about all this kind of, it's basically that they were being bribed to sell certain kinds of funds. And the analogy I always used to give was at the supermarket, at the end of each aisle, you'd see a bunch of products there. And often they were on sale. They were really good deals. Sometimes there was no deal at all and no discount. And I'm thinking, why are they putting it there? Well, the company is paid to put it there. And I guess they don't want to pay more to lower the price. But that was how the mutual fund industry worked. And it was often corrupted by the fact that the customer didn't know any of this. They didn't know anything about costs. They didn't know how MERs worked. And it just wasn't a great deal. So I did all I could to get involved with the reform of mutual funds. And there was an OSC commissioner named Glorianne Stromberg who decided she would do a report for the OSC and did a very long, quite informed report. And it ruffled a lot of feathers. We wrote about it many times, but we kept saying, like, as the years passed, what's going on? What's happening? The OSC had a lot of trouble knowing what to do and tried a bunch of things. And we're here, I think her first report was around the year 2000. And then she did another one for the federal government. And she got very frustrated at the end. But we are getting to the point where, number one, there's more disclosure in terms of mutual funds. They got rid of those trailing commissions that they called it. It was basically when you bought a fund. And back when I started, Investors Group would charge a 9% commission when you bought the fund and another 9% when you sold the fund. Very, very high costs. And then a number of companies also started paying the intermediary, the dealer, for every year that you owned the fund. And they said that it was a payment for ongoing service to the investor. But the investor didn't know about that. They didn't know what kind of service they should be getting in the first place. And they didn't know they were paying for this. And eventually, it took a while too, because when Doug Ford became premier the first time, he immediately canceled, like on the first day, he canceled Ontario's agreement to ban trailer commissions. And finally now he's given in because he tends to backtrack, and it's come to be. So it's gotten better with mutual funds, but as we all know, the mutual fund industry is huge. It's $1 trillion in assets. And the competition, the exchange traded fund, which people can do on their own without an advisor or a dealer of any kind, except for an online broker, it's growing too, and it's growing faster, but from a smaller base. But it's revolutionized the industry because many people who say, I'm going to start investing on my own, they don't want mutual funds. And unless they have a mutual fund dealer, they can't even figure out mutual funds because there's so many of them. And there's so many different classes of mutual funds. So they're kind of disappearing. Well, they're not disappearing, but they're losing their momentum.
So I won't spend much time relating to what you just said, but you and I have a connection through Money Saver. Yes. We both know Lana, and we both knew Bill and Betty that back in the day when they owned it. But back in the 90s, I was writing columns for the Money Saver, and I covered all this stuff, and I talked about these back end loads, which is one of the things you didn't talk about. They'd be this commission where you'd get like a 6 or whatever % commission, and then trailer fees, and the client would be penalized if he or she dare sell their underperforming fund. And the trips. And I saw this. It's funny because the guys in my office, and I was in a brokerage office, and it was at the time it was Merrill Lynch. And that's what they were selling. I mean, we were supposed to be stockbrokers, but I was like the only guy in my office selling stocks at that time. Because I did mutual funds for my first couple of years in the business, and then I stopped doing it because I realized they were inefficient. And what's interesting is that they were making more money than me. They were doing less analysis than me, and they were getting all these trips. And I remember the one guy, he got this giant solid brass bowl given to him by CI, I think was,
okay.
So, and the trips, like they went to Texas and all these different places, for mutual fund things, but really it was just a bribe, So yes, I lived through those eras. And the funny thing is that when I spoke out about it, because I was in the industry speaking out about it, which was because it was all hush hush. The clients didn't know about all these trips and stuff, right? Like you said. But when I was in the industry, I was talking about, through the Money Saver, I was writing these columns and I was giving statistics just like you did about how they underperformed. And he told me to cease and desist. And his logic was, and I said, well, yeah, I emailed it back. I said, this is the way, this is truth. I'm just giving people facts through my columns. And he said, that doesn't matter. Many of your fellow advisors here at Merrill Lynch are selling this stuff and make a living doing it. So you can't jeopardize their business. So it was like, it had nothing to do with what was right for the client. It had everything to do with what was right for for the so-called investment advisors, which were really just vacuum cleaner salesmen selling a different product than a vacuum cleaner. But anyways, I could rant on about that, believe me. But those days are over, thankfully. And funny, I was the black sheep for selling stocks in those days, and now, of course, everybody says, "Oh no, I wouldn't buy a mutual fund." But anyways, I really the key points I wanted to ask you about is what you've learned through your career about investor behavior and how beginners should maybe get into investing, and you don't have enough money to deal with a guy like me, for example.
There's a lot of intimidating factors that face beginners. There's a very rich lingo of terms for investing. And a lot of these terms are complicated. And I found even when I'm teaching investing for beginners, some of these products have names that have to be explained because the concepts behind the names are difficult too. So that can put people off. There's an emphasis on charts and graphs, and many people don't think that way. I found at the beginning that I found the charts intimidating. Now I quite like them. But many people don't think visually. There's also the fact that there's a lot of volatility. You don't know when the market's going to go up or go down. You don't know what's causing it. You don't know how long it's going to last. The first time it happens to you, you feel incredibly nervous, sometimes sick to your stomach. Sometimes you can't read. And then you have the wrong behaviors. You start checking prices even more often than before. You start listening to all the newscasts. You start hearing predictions. When markets are going down, everybody has predictions. And it takes a year or two at least to start realizing that predictions are a commodity like anything else. There's no value. They're very cheap. Everybody's got one. And very few people actually follow up their predictions to say, I was wrong, I was right. So don't get spooked by predictions. And no matter how many initials somebody has behind their name, that doesn't mean that they know what they're talking about, because nobody has a crystal ball. And a book that I never read, because it was also a difficult book to read, but everybody talks about now, is Black Swan, which means that when you're predicting, you're looking at things that you can reasonably anticipate, usually based on the past. But then a black swan is a very, very rare phenomenon in nature. And often the worst corrections in the market are caused by something that's totally unpredictable. You could say probably that COVID-19 was. Yes, there were a lot of people predicting that a pandemic might come along again, but nobody knew when, how serious it would be. And in our lifetime, I don't think we remember anything that caused so much economic disruption to so many people. And even now that it's more or less, tame, we have all these businesses who are going out of business because they took loans from the government and they can't pay them back. So you have to be more humble about investing and realizing there's things that you don't know and things that you might partially understand. And luckily for us as investors, there's places now where you can go, like the Ontario Securities Commission set up a site called Get Smarter About Money. And they've just revealed a new upgraded version. They're using AI. They're doing the best they can to make it absolutely simple for people. And then when they realized that there was a problem with too many people piling onto crypto, they did one called Get Smarter About Crypto, which is even a few notches lower in terms of simplicity and easier for anyone to follow. We have people like Preet Banerjee, who came out of the financial services industry, and now he's like a moderator, and he writes books, and he has a YouTube channel that he's had for a while, but he's got like 125,000 viewers on YouTube. And he can really explain things well. We have David Chilton, who's still around. He's got his books, and he's now a spokesperson for RBC in the estate planning area, because they realize that a lot of people haven't got up-to-date wills, they haven't got an estate plan, and that maybe they could use a trust company like RBC Royal Trust to help them with their executors, or to help their executors after they die. And he's doing YouTube videos. So there's a lot more out there. And in my view, I love to read. I'm a lifetime reader, but I think for many beginners, the reading is tough. The easier thing is watching people talk on a video or watching people go through a slide on the video. There's a lot more visual stuff going on. I discovered a guy on Twitter called Brian Feroldi, Feroldi. And it turns out he only got started as an investor in 2004. but then he got interested in charts. So I don't think he does technical so much, but he has charts for all kinds of things. And he's got a newsletter, and he has a course that he sells about how to read income statements and balance sheets. And he is quite interesting to watch. So if you're still on, I guess call it x.com now, but it's FEROLDI, Brian, and he's out there, and he also writes for Motley Fool, which isn't the best out there, but they've been around for a long time too, and many people just like following them. So it's easier to be a beginner, but for many people, they just can't manage to do it on their own. Even if they understand it, it takes time. It takes a lot of time. And if you're busy, you have a family, you have a job that requires a lot of extracurricular work, you're not going to do it. So then you have the question, okay, I probably need an advisor. What kind of advisor do I need? How are they regulated? That takes a while to learn about as well. And then the other thing is, what kind of relationship will I have with my advisor? When I started with mutual funds, I'd never bought a mutual fund, and I had to do it through an advisor. And one day I'm out on the street, and a neighbor, we were fairly new to this neighborhood, the neighborhood said, Connie? And I looked at her, and my mother's name was Connie. And it turned out she was a cousin of mine and knew my mother, who was in Montreal. And we started talking, and she said her daughter worked for BMO Nesbitt Burns, and she was a stockbroker, and we should meet and talk. And at that point, I was really nervous, and I was afraid that investment advisors would be overbearing, overpowering, after my money. And then when I met her, she was my cousin, right? I didn't know her. She grew up in Toronto. I grew up in Montreal, but I felt confident with her, and we worked together really well. She told me everything that she was thinking. She was the one who got me from, first we were in mutual funds, but she only looked for ones with really low management expense ratios. And then she said, how would you like to start investing? And she was the first thing from a trend investor. She was looking for the stuff that was boring, Russell Metals, that was one of her favorites. And she was looking for value. And with her help, I got into individual stocks to the point where I had very little else in my portfolio. And then her husband had a business that she wanted to join, so she left. And I'd already moved. I had a locked-in retirement fund, which I started managing myself. But then I took my RSP and started managing it myself, and a taxable account that I started after my parents had died. And it was all invested already. So it made it really easy for me just to keep going. And luckily, until I stopped working full time, I never had time to do much trading. So I was buy and hold. And that was all I really wanted to do. But I know that at the beginning, it's tough for the investor to watch everything go down and to think they're smart enough to know how to get out. But the problem is they're never smart enough to know when to get back in and how to get back in and so on. And so the thing about advisors is that, what kind of relationship are you going to have? Are you going to participate with them like I did with my former stockbroker, where we talk a lot before we buy or sell anything? Are you going to delegate it to them? So they're going to do it pretty much on their own, and just as a formality, they'll tell you what they're doing, but they don't expect any response from you. And then the last one is the worst, where you abdicate. You just say, okay, you're the expert. I don't know anything about this. If I get involved, I'm probably going to make the wrong decision. I'm going to leave it all up to you. And as you know, that's just a way to get yourself really in trouble, because you can't let anybody control your money. And unless you watch it carefully, even good people can sometimes get carried away by the fact that there's no supervision, there's no monitoring. So that's something else you have to look for. And again, there's ways now to find advisors. The Financial Planning Canada, they help you find a financial planner near you. And I believe that in general, you should have an advisor who's not just investing for you. They should be looking at your tax situation and trying to help you save taxes. They should be looking at your insurance that you have and whether or not you need more of that. They should be looking at your kids and saving for your kids' education. So a financial planner is somebody to get on board with really early. There's a site called advisorsavvy.ca, which also does that for people. It's more like a private sector initiative where the financial advisor pays to be on the site, but they're checked out thoroughly, and a lot of them are turned away. And the site also has a ton of good information there about finances. So it is getting a lot better for the average investor, but it does require some time and attention, and you can't just do it vacantly. You have to put your mind into it.
Excellent. Well, yeah, Ellen, and that's good input, because again, there's going to be a certain portion of the audience watching this today that are pretty new. And like I said, as you know, I'm a portfolio manager, and I've spoken to your group and stuff. But our we have fairly high minimums to come in and deal with this. Now, yes, when you deal with a portfolio, like a registered portfolio manager with the Ontario Securities Commission, like we are, not even at the IROC level, we're very overseed. You do get your communication and stuff because you have a higher net worth, and therefore you're dealing, we have a minimum of $500,000 to come in to deal with us, and that's our rock bottom minimum. So you're going to get that service. But the problem for a new investor is they don't have that $1 million or $2 million portfolio or whatever that guys like me take in all the time. So they're going to have to find somebody that actually is honest and actually will communicate with them and doesn't mind the fact that they're maybe only starting off with $20,000 or whatever that is that they're starting off with. So it's a challenge, but those are good resources that you've given. So I appreciate that.
Yeah.
And,
also, if you, as the parent, have an advisor that you like, they often will take on your kids as well, no matter how little money they have. And my husband likes to invest with the bank, and he has index funds with them, and we have a personal banker. And so they've taken on our two sons, and they keep in touch. And my son was asking me yesterday about, he got some money from the government because his employer went under and he didn't get severance. So he got something like $8,000, and he said, what should I do with it? And he called the banker and he said, should I put that in my RSP? And she said, no, because you're not working full time right now and you won't need the tax deduction. So put it in a TFSA. I'm not sure if he even has one yet, but he'll start one. And it's great that he can do that, because I'd rather him talk to a banker than talk to me, because when you work with your family, it can often result in hard feelings later on.
Yeah, that's right. It's actually, that's a good point, because most portfolio managers, for example, like my world, they'll deal with higher net worth people, but these higher net worth people have kids, like you're talking about, and most of us, our value trend for sure, and I think most of the better portfolio management firms out there will operate as a family office. So we offer, Craig, he's a CFA with us, and he does the financial planning for our clients as well as the fundamental analysis of our stocks. But we also take on the kids, and so the kid might only have $20,000, like I said, but because that child is part of the family and we're a family office, we'll look after that. So that's another good point, is that you can usually go as a beginner investor to whoever your parents might be dealing with. So I'll finish up with one last question, and that is that final tips that you want to give. And this is, you can see I'm reading off a sheet, people, because I often have to write down questions in order to not forget them. So are there any tips you want to give to the viewers about retirement saving and the eventual need for retirement income? So anything you wanted to pass on your words of wisdom in those areas?
You should start retirement saving early. We used to invest in GICs at one point that were paying like double-digit returns, 13%, 14% during the inflationary times. Keep track of your RSPs. My husband lost track of one of them, which was with a trust company, and he bought it way back in the 70s. And then it just rolled over, and they kept sending mail to the wrong address, so we didn't know about it. And then finally, when he became 71, that RSP GIC was turned into a RIF, and the payments started coming out and being mailed to the old address. And he didn't even know about that until finally the CRA caught up with him and said, you have this payment to Scotiabank, and from Scotiabank, you haven't paid tax on it. He said, I've never been a client of Scotiabank, and it took a long time to track it down. And we finally found out it was a smaller trust company that was taken over by Scotiabank. And then once we got to Scotiabank, it took them a while to figure it all out, but now it's finally resolved. So it's important to keep track of these things. Plus, if you work for a company, you might have had a pension. You got to keep track of that too. In fact, as I get older, now that I'm retired full time, there's a lot to keep track of when it comes to taxes. Like the investment return is important, but I have a feeling after watching the markets for so long that the stocks will come back. Even if they go down, they come back. But when it comes to the taxes, unless you're well organized, unless you have all this information handy, the CRA can really get after you with interest and penalties, and it can be quite difficult. So you become a lot more conscious of taxes. Now you're paying quarterly installments. With my husband and I, we were lucky. I think the tax system favors married common law couples because once you start getting pension income, you can split it with your spouse or your common law partner. And it makes a big difference because I always had full-time jobs with defined benefit pension plans. And I have a fairly good RIF as well. So my income's a lot higher in retirement. So I can take half of that and give it to my husband. And so he's paying a bit more tax, but I'm paying a lot less tax than I would have normally. And the whole idea of saving for retirement is just do it, start early, keep it going. Don't get discouraged by market setbacks. They will come back if you take the long term. I saw Dave Chilton give a speech once in 1999, and we were all worried in the fall about the Y2K. The computers were all going to fall apart because they weren't designed properly, and all our investments would be derailed and we'd have no savings. And he took that on and he said, okay, it's kind of implausible that this is going to happen, but suppose it does. Imagine yourself 20 years later, you're now in the year 2020. Are you going to say, well, I have no investments because back in 2000, we had this computer problem? Said you always have to think well ahead. Don't think 2 years ahead, think 20 years ahead, and just make sure that you're well set up for things. Thing about retirement is that you have to take the money that you have in various places. So you have pensions, you have the government, you have company pensions, you have your own savings, you might have your principal residence that you can downsize and use some of that equity. It's called decumulation. It's been around that name for a while, but there's an author called Fred Vitisse, who was a chief actuary at Morneau Chappelle, and he's written several books about retirement, and his latest is called Retirement Income for Life. It came out in 2018 in paperback. And he revised it once a couple of years later, and his newest revised edition is coming out in January of this year. So it might be in bookstores already. And he is an actuary, which means that he has some technical language, but he's gotten good coaching in terms of writing it for the average person. He takes a couple and follows them and seeing what's going on. And if you have any doubts about what happens once you get into your 65 plus years and 71 once your RSP has rolled over into a RIF, you need to know what your alternatives are, and it's a really good book that way. So I think that if you read that, you probably would be more well informed than many of the financial advisors out there, because we know that they love the idea of retirement savings because you do it every year. They get the money every February during RSP season, and their assets under management keep going up. And that's important for them because once their assets hit a certain level, they might be promoted to being a vice president, which means nothing other than a fancy title that you get more clients with. And then once you start hitting your mid 60s, 70 plus, then your assets are being drawn down. And nobody likes to see their assets under management go down. So they're not as willing or anxious to do that. And they might find it a lot more fun to go after people still with 20 or 30 years before retirement. The other thing I want to point out is that must have been 6 months ago, the Bank of Montreal put out a survey of Canadians. They're not big surveys, but they asked them all, how much money did they think they would need to save in their nest egg before they retired to be comfortable and not have their money run out? And the consensus figure seemed to be $1.7 million. And seemed like a lot. And even the bank, when they put out a press release, said, we don't think that's really realistic, that the figure is much lower than that. And there's several books out there that tell you that you probably need, and Fred is one of them, and there's a guy called David Traher who's written about retirement for procrastinators. They're saying as long as you have somewhere from maybe 750,000 to $1 million, you'll be fine. The caveat is that you have to make sure that you are watching your expenses, that you are not a big spender, that you have a budget, that you're trying to keep costs down, but many discounts for seniors these days. There's lots of places to live where costs are lower. So don't get intimidated. Don't start thinking that you're way behind and you have to put all your money into the RSP. And for the younger people, I'd say, yes, put money into the RSP if the tax deduction is good for you. But when you do get a tax refund as a result of your RSP, don't spend it. And I know I did that sometimes. My car needed a big paint job, so there was my windfall coming in April when I filed my taxes. Reinvest it into your RSP. If you have kids, you can reinvest it into an RESP for the kids. Now we have the first time home buyers savings account, tax-free savings account. So there's lots of great things to do with it. So make sure that you're using the tax system properly. And just make sure that either you do it on your own and you're really well organized. I find that people who are engineers tend to be really good with money because they're terribly well organized. Or you have a really good advisor who you believe, after working with them for a number of years, is putting your interests as a customer, as a family, as a citizen of Canada ahead of their interests as a person who needs to make a living and maybe wants to keep it into retirement. So those are my words of advice, and it's been really nice to talk to all of you clients. I'm sure that Keith has been a wonderful advisor for you, and Craig, who I've never met, but Craig comes up a lot in these conversations. So have a great 2024.
Thank you, Ellen. And that was excellent. Actually, I'll just mention one other book when we wrap it up. I can't remember the name of the book, but a man named Jim Otar. I don't know if you've met him, Ellen.
Yes. That book had way too many graphs for me.
Yeah, so it's my kind of thing. I love stats.
Exactly. When I was at the Globe and Mail, I was approving a lot of freelance contributions, and he kept sending articles, but they were mostly those very busy graphs, and I never actually did it. But I did discover Tim Sesnick. Do you read him?
Oh yeah, Tim. I know Tim. Yeah, I've met him. Yeah.
And the reason my brother's an accountant, and I know a number of accountants, and they all are horrible writers. And then one day I was in a bookstore and I noticed he had written a book for his firm. He lived in Burlington, so he had a firm in Burlington, and it was a smallish self-published book. But there was something about the writing that I found really good. So I got him to write a few articles. And my editor, after maybe, I think we were running him once a month, and she brought him down to every 2 weeks and then once a week. And he's still doing it. So this is 25 years later, because he's just got a knack for being able to transmit tax information and make it interesting.
Yeah, he's great. I mean, Jim is. I just like Jim's book because it's very realistic. He uses 100 years of history to, to talk about what could happen in the future. Anyways, again, thank you for coming on board and doing this interview. This is really going to be a great resource in the video file with Value Trend to point new investors towards to watch, because you gave great tips. Lots of resources and books and stuff you mentioned, websites and Twitter following and stuff like that. So there's going to be a lot of information that comes out of this. So again, thank you very much for all those great insights. Okay. And we'll see you in another show sometime, I hope.